One more time. This is Bush League. I'm Tobias Carlisle. This is Value After Hours. My co-host Jake Taylor and Bill Brewster are here as always. Jake, what's your topic this week?
Well, I feel obligated, like we need to talk about coronavirus since it's such a big deal right now.
And Bill, what are you talking about?
Going to talk about thinking about the future a little bit more and my recent visit to the West Coast and how it got my mind frame a little bit different.
And I'll be talking about the swift rebuke that the market gave to Cliff Asness's article on sinning a little in value, where it then sold off for the worst 6 weeks out of a really bad decade, which led him to write another note saying, "Never has a venial sin been punished so swiftly." We'll be talking about that right after this.
Tobias Carlisle is the founder and principal of Acquires Funds. For regulatory reasons, he will not discuss any of the Acquires Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquires Funds or affiliates. For more information, visit acquiresfunds.com.
So we're in the second day of a big sell-off, just so everybody can contextualize where we are. I've been talking to a few friends of mine. Chris Cole, who's a vol guy, he has all of these little he monitors all of these different funny relationships between things. And one of the relationships that he monitors, which is something that I have believed for a long time, is that he monitors value relative to growth, value relative to the market. Because I have this theory that value sells off first. In a bull market, the tail end value just doesn't get a bid. I think it's because value guys tend to be a little bit more disciplined. It's not the stuff that's going up definitionally. That's where everybody's kind of piling in. So value definitely starts pulling back first. We saw that in 2007, definitely saw that in 2000, although it was years early in 2000. And I think that we've been seeing it over the last 5 years where value kind of sells off and then catches back up again and sells off. And I think that the most recent big sell-off over the last sort of 8 weeks was interesting, and that it came on the heels of Cliff Asness at AQR had this article where he said timing factors is really hard to do, but he advocates for when they get to extremes, he advocates sinning a little, by which he means allocating a little bit more to whatever factor is the one that's currently doing the worst at the time. So he came out with this article saying sin a little in value because it's underperformed so well. Just as a precursor to those 8 weeks where it's had its worst 6 weeks in the last decade, it's probably the worst 8 weeks in the last decade. And so he had to come out with a second article where he said, "Never has a venial sin been punished so swiftly."
Yeah.
I think it's kind of funny that like value has been selling off pretty consistently for the last 8 weeks. And now we have, everybody was sort of wondering when the volatility from coronavirus was going to materialize in the markets. All of a sudden, we've had these 2 violent days of selling. And I wonder whether it's coronavirus or whether it's just the market's been expensive. There's a lot of weakness underneath. I mean, you look at Japan had that big negative 6.3% Q4 GDP print. That's pre-coronavirus. Who knows what's going to happen? Maybe it's like a broken window fallacy that if you kill enough people, there's enough of a response from all of the authorities that somehow that gooses GDP. I hate those theories. I think they're wrong. But maybe that does show up in a quarter of. Maybe it shows up in a quarter of people spending money on face masks or something like that. But I honestly don't think that's going to happen. I think shutting down all the factories is really going to hurt, and the supply chain. And we're going to see that in maybe not even in the next round of reporting. We're going to see that in that's the Q1 reporting, which comes out mid Q2. Q2 reporting, which comes out mid Q3. So I think this thing probably potentially rolls on all year long. I think I've just stepped on your topic too, Jake. There. Sorry about that.
It's okay.
Matrix.
If we want to.
Back into the Matrix.
Matrix got you.
Go again.
I said we could just do a big blended show today if we want to. This can just be a
coronavirus special. Markets in turmoil.
Markets in turmoil grab ass edition.
That's right. I might have to go get a Corona.
What do you guys think?
Well, let's go back to Cliff's paper first. And first thing I would say is like, boy, I kind of miss Cliff on Twitter.
Oh no, it sucks.
Why do you have to go away? Regulatory reasons?
No, I think he just gets too angry. I think
he gets too angry,
health.
and people, yeah, and I get it. Like he's probably smart to do that, but
to his
maybe
credit,
if we all we'll treat him well.
He's not the kind of guy who you don't have to have a blue check mark to get a response from Cliff. Like any random dude who set up a Twitter account 15 minutes ago can go at it with Cliff.
Like, yeah.
And he'll take it earnestly. Like he'll respond as if they're not just trolling him. So God
maybe
bless him.
there's a healthier way for Cliff to come back into the fold.
As an egg.
Yeah. He might be out there right now. We don't know.
Trolling. Yeah,
that's right.
He should stick a big shark fin in his bio, in his profile pic, and just like swim up and gore people the way that everybody does to him.
I'm gonna check for random eggs citing AQR papers.
He wouldn't give it away.
So anyway, what about the paper, Jake?
Yeah, I just thought it was. I really appreciate the way that he approaches investing and his quant kind of mentality, and like he really is humble about it in a way that I find attractive. Like he doesn't act like he's got it all figured out, but he sticks to his guns at the same time, and so I find that combination of humility but also discipline. Like I root for him to win, and obviously he's like won a lot already. Like
his thought process is externalized. So he's not saying I'm Cliff Asness with a PhD from Booth and $200 billion in the fund and I'm a billionaire. That's why you should believe what I'm saying. What he's saying is, here is the data and here is my interpretation of it. If that's wrong, then show me where.
Yeah.
Good approach.
He had a great line in there that let me see if I can find it. You guys talk while I'm looking.
With respect to how long coronavirus goes on, I think it might be Q4, man. I mean, I think we might be into December still hearing about it.
I'm
if
sure.
Nothing else.
I'm saying at a minimum.
Yeah. Dan McMurdy was pretty early on this. I don't, like you, I don't know how much is necessarily coronavirus related, but I mean, when you start working back through the supply chain with all the operating leverage that is in supply chains now and all the just-in-time inventory that everybody has worked so hard to get to, it could be a real deal.
Yeah, it's surprising that it hasn't shown up yet. I guess the US just hasn't panicked yet properly.
Yeah, I don't know. I mean, I think one thing that we all sort of forget is that if we looked at sort of like dollar weighted paying attention, there's a lot of money out there that is not, they're not living this stuff all the time. Like they're living their lives. They're doing other things. They're going to their kid's soccer game. They're not hanging on every single like report and, on Bloomberg or on Twitter. They're just living life. And so I think the underreaction sometimes surprises us because it's like, dude, doesn't this seem like a bigger deal? No one's paying attention. Nothing matters anymore, right? But maybe it's a little slower to diffuse out into the ecosystem than guys like us who are on the front lines think about.
I didn't think about it. I was like, this is SARS 2.0. It's bird flu. I've been through this before. It is bigger than that.
Yeah, I joke to my wife that the CDC has its annual advertising campaign, and they come out with Zika virus. Be worried about that for this year. SARS this year. MERS this year. And then this year they were like, we're going to come up with something new. Coronavirus. But I don't know anything about anything. I don't know anything about anything. But it does seem to be worse than those other early advertising campaigns. I think that this is a real blockbuster.
Well, Buffett was saying it yesterday, right, where he was on CNBC and he was like, he was basically saying that he talks to Bill Gates, but he wouldn't be like Bill Gates thinks this. But apparently Bill Gates thinks that it's going to last through the heat, and we'll see. But I think Buffett was hinting that he thought it might be a bigger deal than people let on. But I could I don't know. I was tired when I watched that.
What do you mean you don't know anything? We're all now virologists and supply chain managers.
Yeah. Haven't you gotten your Twitter education on viruses?
Yeah, it's beyond me, honestly. I try to ignore anybody who expresses an opinion.
Well, I'll tell you how it won't get beyond you. You could have a concentrated position in airlines, and then it comes right to your front door.
I got a little position. It's hard to pick out the airline from the rest of the portfolio. There's a lot of red in there.
I'll tell you who I like. I like the guy I mentioned, and for anyone that thinks that I've fully abandoned value, this is a 10 basis point position in Splunk. And this guy's like, I thought you were a value investor.
I saw that one.
Well, listen here, dude. I still own the airlines, and it hasn't been fun. So I'm so happy I have this label that you've put me in. Oy vey. Like, Spirit off 10%, Ryanair down 11. I mean, I don't really care, but it was a painful thing to look at.
Is that impacting the domestic carriers? Because I got a position in Love. How's that tracking?
Yeah, I mean, I guess the argument is it's going to reduce the amount of people coming into the U.S., and that's going to hit load factors. I think that this is a good test, right? Everybody that is long the airline thesis has been saying, like, well, they're going to be able to pull in capacity. So let's see. It's we'll find out if we're right or not. But even if we get through this, people are going to be like, well, the MAX was out of production, so we have to wait for a recession. I don't care. Keep the cloud of doubt on. We'll just buy in all the shares.
I know this man who runs a manufacturing company, and he keeps 6 months of inventory on hand at all times, which, every MBA from McKinsey would have, screamed bloody murder about tying up that much working capital. However, on these type of situations, when he's the one who's still delivering and no one else can, what do you think that does for his brand and for his company? And does it much more compensate the cost of carrying extra inventory? He said he does it for the same reason that we have two kidneys. Like you need to.
You got a backup.
You need a backup, right? Because shit can happen, and I think that's really smart. And I wonder if maybe a lot of public companies, especially, aren't doing enough of that kind of long-term thinking and trying to optimize for too short of a time horizon.
Almost certainly. How could you justify that?
Got to get your ROIC up.
Yeah, that's right.
So all the compounder boy can buy it.
Yeah, that's right. You got to sell all your assets, sale lease back them, get your ROIC going, and get your stuff streamlined. Especially with rates at like where they are. I mean, carrying some extra working capital is not. I mean, you just finance it.
Yeah. What one thing that's kind of scary to think about though is if this type of thing creates a push away from specialization and a more towards localization of resources and economies, it kind of makes, like, if you look at like Tibet, for instance, they're a relatively poor GDP per capita, and it's because they're on an island, relatively speaking. They don't and they're jacks of all trades. Like, they know how to fix a diesel engine and, do a million different things, but they're not specialists at any one thing, which is what tends to create the most wealth when you have the facilitation of trade. Well, if everyone goes back to being local experts more because of something like this, like, we could be materially poorer potentially as a species.
Well, here's another view though.
Yeah.
So Josh Wolf says that advances in 3D printing are coming, and the impact of those advances in 3D printing is now you won't be sending all of this stuff around the world on container ships. You need the raw materials, and you'll just make it close to where you are. Maybe there'll be a fab in your little city or your town or something, or maybe you'll have your own little 3D printer at home, and that'll get you most of the things you need.
That would be awesome. I think it's a pretty good reason to maybe question an energy investment.
Anytime you feel bad about the world, go and watch an interview with Josh Wolf and all the great stuff that's coming down the pike. I can't wait. The thing where you don't have to have a chip implanted in your brain. They're going to stick a band around your wrist, and it can interpret what you mean when you're you type something in air, and it'll appear on the screen. It'll be nonsense, and your frustration with what has appeared on the screen will teach this thing what you wanted to type, and it'll eventually just figure it out. So you will have different gestures to the person who's beside you, but your band will know what you're trying to indicate. So you won't have keyboards or any other interface other than this thing on your arm. That sounds great.
Does it?
Do you like typing?
If you couldn't get Twitter out of your brain, like I got to be able to take
in your
this
brain.
thing off.
It's on your wrist.
I'm just saying. I got to be able to take it off. All right.
Turn your notifications off.
That's what it is. All right. Yeah. I need that.
Do you want to do it? Do you have any particular coronavirus insights that that's your topic that I was stepping all over, Jake?
I mean, I kind of shot my wad already, but I would say, honestly, I don't know enough to really say anything smart about it, other than, it could be a bigger deal, and I do kind of agree with some of these ideas that it might take a whole year or something to work through. Here's an interesting idea, though. What if because of this we shrunk the pile of goods and services in the world, and contrast that against 10 years of money printing, and this is what actually triggered inflation, like a supply side shock?
Right, but we haven't had one of those for a long time, right?
Long time, right?
When's the last one? Is it 70s?
Yeah,
Is
like
it oil
embargo probably would be the last time we had something like that. But I mean, why wouldn't stagflation be a potential outcome that I don't really hear anyone talking about much?
You're rooting for it so bad.
No, I'm not. Those are awful. That's terrible.
Well, it wouldn't be permanent, right? I mean, you're talking about. I guess it all
years,
depends how long this stuff goes on.
Could be years.
Yeah.
Why? I think that coronavirus is worse than everything else. But why is that? Why do you think that this is worse than SARS, MERS, Zika virus, whatever?
I mean, for me,
I don't know.
I'm stealing Super Mugatu's thoughts here, but I think he had the best thread that I've seen on how it can ripple through the supply chain, and how much, like, when your cost structure is not linear, right? So if you stop production or you're underutilized, it's not just so easy to absorb. And if that starts to result in layoffs and stuff like that, I mean, it can become a little bit of a reflexive downward spiral, I guess. I know with respect to airlines, they get a fair amount of revenue from the cargo that they have under their planes when they're flying. That's gone down. I still see pretty full flights. I've been on 2 in the last 2 weeks, and it hasn't been a big deal. Or 4 legs, but that's all domestic.
You're still in your 4-week quarantine period, Bill. That's why you've been sequestered.
Yeah, I went to California. They're trying to keep me sequestered now.
That's what you should have told the missus. Like, I got to stay out in California. I'm in quarantined.
I would wish. Oh, if only. If only.
What's your topic, Bill?
Well, I had the ability to go out to Google, which was super cool to visit, and just being out in California, I find it interesting, the conversations that I had out there, not necessarily at Google, but just meeting with people. I think that there's an interesting arbitrage, for lack of a better term, between the West Coast and the East Coast. I sit in the middle in Chicago. So, like, the most exciting stuff that we're around is how many dairy farms are popping up. But it is interesting how, like, some of the people out there view it as an inevitability that Tesla is going to own the electric grid, like, tomorrow, right? And my mind, as sort of somebody that's tied to value, is to bet against change. So to surround myself with people that are more focused on change and where the world is going, I found to be a hugely beneficial use of time, and I hope to do it much more often. I'd like to incorporate it into my life a lot more.
So, how does that affect your investment kind of outlook of the world? Or do you think you said before,
sounds like you got to go buy some Tesla.
No, I'm not.
Very smartly have said before about the downside tail being respected by value investors and the upside tail being value or appropriately appreciated by growth investors. Does this change anything for you?
Not really. I mean, I did take that massive position in Splunk, which, may be the wrong one to take. It doesn't even matter. It's like I said, it's 10 basis points. I mean, I know every dollar matters, but the function of that, it's the only one that I have that's like that. But I want to sign in, and if I check my portfolio, I want that as a reminder to think that way. If I lose 10 basis points, I don't give a shit. Like, it really doesn't matter to me relative to the benefit that I think that constant nudge is going to give me. I'm not going to litter my portfolio with that kind of thing, but I do. That's probably the one tangible change.
It's a tuition investment.
Yeah, I think, it's probably suboptimal, but whatever. I think, like, I need to spend more time studying some of the stuff that's going on, specifically in the cloud, and how like last week I was talking about data and how I think it's sort of akin to a hoarder's house, where like people are like, oh, look at all my stuff, but you can't find anything. There are companies that are helping people with that. So I need to focus my time and attention on how people are solving that big need, and then be patient, because I'm sure all that stuff is priced to perfection.
How do you ascertain how knowable some of this stuff is? Because I find it to be like, when they explain it to me, these very, very smart people, I go, okay, like that makes sense to me. And then it's like the Chinese food effect with Feynman, where they said like they could have a conversation with him and it would all make sense, and then 20 minutes later it would be like, I can't explain anything that he just told me, right?
Yeah, I think that's fair. I think that the best way that I am going to try to do it is to try to go out there more often and to try to talk to people and figure out if I can figure it out. And if I can't, then I can't. But
don't forget Silicon Beach in Los Angeles.
Oh God, I love LA. I mean, I love Cali so much. I don't have to live there, so I don't have to deal with what you guys complain about occasionally. But I don't know. I can't wait to get out more often. And I guess it's just surrounding yourself with people that are working in the companies, talking to customers, and trying to piece together something, right? And if it doesn't work, then so what? But at least I'll say, hey, I tried, and have some interesting conversations.
Toby, do you try to insulate yourself from those kind of conversations, giving your strategy that's more of a, I'm not going to make any predictions about the future, I'm just looking backwards? And
no, I like talking to people about, I like all that futurist stuff. I love science fiction, hard science fiction, future. Yeah. And I love the Josh Wolf interviews, for example. I love all of that. He's like on some line between sci-fi and sci-fact, he says, where he's trying to seed these things. I think all that stuff's super cool, super interesting, incredibly hard to invest in. The long term. So I've looked at the long-term returns to Angel. Like, they're not that good. Angel's really hard. Long-term returns to VC, not that great unless you can get into those top quartile funds. And I think that the reason that they succeed so well is because it's a signaler for an entrepreneur and a startup to get an investment from Sequoia or Benchmark, whatever. And so they do get the better cut of deals, and so they do a little bit better. I don't think that they've got any better picking skills than anybody else. I think it's incredibly tough. I think that what markets like this do is they make people forget that the objective when you're investing is to find things that are mispriced. Whether you're a value guy, whether you're a momentum guy, whatever you're doing, you're finding things that are mispriced. What this market has done over the last 5 years is it's rewarded that first order thinking where you say, this is a really good business. I like Netflix, I like Amazon, I like Facebook. And then you go and buy some, and that has done very well. Typically, what gets rewarded is second order thinking, where you say, I like that thing. What does Peter Lynch say? He says, go and do a valuation. Oh, that's really expensive, but no, I like it, I'm going to watch it. So I have pretty consistently over the last 5 years been looking for mispriced things that hasn't been rewarded, but it does work over the long run, so that's what I'm going to keep on doing. But I still love sci-fi.
Well, I guess that the one pushback that I'd give on that is some of these big tech companies have gotten, I think, a lot bigger than people thought that they could get, and a lot more profitable. So I do think that there is an upward inflection. I agree with you on many of the things that I look at, that it's just sort of multiple expansion, but some of this has been like crazy growth that I don't think
they were probably
been able to see.
In other markets,
mispriced lower.
So Microsoft, which has been doing very well and had lots of multiple expansion over the last period of time, you can go back the decade before and have a look at how it performed there. I mean, they were doing pretty well through that period too. Mm-hmm. You know, the revenue growth was roughly similar, but multiple compression did what happens normally to high growth companies, that they see that high growth in the earnings, but they also see multiple compression because the market gets too far ahead. That is what has happened at almost every other juncture. It's not happening at the moment. They're getting multiple expansion, but I think that it's almost a certainty that we go back into a market at some stage where high growth sees multiple compression, low growth sees multiple expansion. I don't know when it's going to happen, but I'm pretty confident that's what happens.
How do you think about some of the pushback that comes at value from like the ROE perspective or the low returns on invested capital? I mean, if you're doing a value study, you're rolling out of those every year, right? Is that accurate? I mean, I know that it's. I'm trying to figure out like
So some sort of back test.
Studies,
yeah.
So when you read the studies, it's not really like these businesses, if you hold them for 5 years, you outperform. It's just in general the value factor, if you keep rolling, outperforms. Is that accurate?
So the value factor is price to book, but let's just say value generally, like any low price to a fundamental. The back tests typically run rolling on an annual basis. I think the gold standard is lag the data 6 months, so you're trading in June on the K data. So everything's been disclosed to the market, and then look at what the composition of the returns. And the composition of the returns over the next sort of 12 months tends to be the earnings for value don't do as well. They do seem to compress, but less than the market anticipates. And so you get this multiple expansion. And so that is typically how it has worked. So when someone looks at my portfolio, they might say, well, that portfolio is full of dog shit. And I don't disagree that those businesses are struggling. I mean, I think their balance sheets are very strong. They're still generating free cash flow, and they're close to cyclical lows. So what I'm trying to capture is an increasing return on equity, but from a compressed return on equity, increasing earnings, but from a trough, and an increasing multiple expansion. Last few years, for a variety of reasons, not all three of those have occurred at the same time, but I still think the businesses, like as a whole, if I tell you what the portfolio is like, 11% free cash flow yield, buying back about 6% of its stock, growing at about 15% a year. I mean, that's, from my perspective, I like holding something that looks like that. I would buy a thing that looked like that.
Yeah, that's a decent conglomerate.
Right.
Yeah.
But it hasn't been working. Like, you can just see you can look at, Hussman has that chart that he publishes every now and again where he says, here are the 10 deciles. And you can just look at how the 10 deciles have tracked over time. Last 18 months, that value decile has been falling in terms of its valuation. That most expensive decile has been rising in terms of its valuation. That is what has driven, over the last 18 months, 2 years, value to underperform. Not saying that some of those very good companies don't justify. I mean, I said last week that I thought that it's one of those unusual bubbles, or not bubbles, sorry, one of those unusual booms where I do think that the ranking is roughly right. Like, I do think that the better, more cash-rich, fast-growing, high return on equity companies are the ones that are being rewarded. But I think that the train to make that investment, the point that you wanted to make that investment was roughly 2010. And you wanted to get on that train. And that was when Jake at Economic pointed this out to me. Forward PE for value in 2010 was more expensive than the forward PE for the growth glamour decile, for the expensive decile. I've never seen that before. I didn't notice it at the time, but I think that explains a lot of the last decade of performance for that growth glamour expensive decile. And I think if that occurs again, then you want to be a growth guy at that time. But I think that if you look at the market now, and Cliff Asness has said this in his original Venial Sin paper, it's like value was punished properly for 8 years. Value's been over-punished for the last 2 years. And he says that now that's why it's so stretched, and now you want to be more of a deeper value guy. That's my argument.
I like the framework of the market exists to humiliate everyone. Like it's right that Cliff should write that paper and then get egg thrown on his face. Like that's how the market should react. And now it's time for everybody else to get egg on theirs.
When do you ever get how many 2019 victory laps did you see?
Right.
that the market gods should, if they were just, would be very punishing.
Yeah, that's true. Yeah. 2020 should be set up for some kicks in the pants.
But the deep value decile has had, the last 17, 18, 19 have been among the worst in the last 20 years. So it's.
So you're telling me there's a chance.
I also think that, and this is something that I probably can't mention his name, but this is something that I have heard from an investor who I have an enormous amount of respect for, very, very wealthy, very, very successful over a very long
Bill
period
Brewster?
of time. There's a volatility. When there's a regime change, there's enormous volatility. And so I think that we've seen, and the way that manifests is, value, the sell-off becomes steeper and steeper, and the underperformance becomes greater and greater, and you get this enormous volatility. And I think that indicates regime change. I thought that we saw it in August, September last year, but we sort of have gone back into this sell-off market. So I think, maybe Corona. I think it probably do need a real sell-off for there to be a proper regime change.
I tell you, this coronavirus has reinforced to me that balance sheets matter when they matter. It's like one of those things that when everything's going fine, you can push it a little, but when you need some anti-fragility.
Well, if anything, right? A really chunky balance sheet makes it hard to have that high return on invested capital, have that high return on equity. If anything, it's a drag through the good times.
That's right.
The only time that you want it is when the market gets the stuffing kicked out of it. So guys who've gone through big drawdowns a few times, one of the first, I'm pretty scarred, but I first started investing in the early 2000, and I've been through another one since then. So I'm like risk first. What's the balance sheet? Are these guys going to survive? Like if we really go into something nasty, does this company emerge at the other side? Worry about the return of your capital before you worry about the return on your capital.
Yeah, I'm living with that right now in my beloved AB InBev. I think they survive almost certainly, but when I entered that, I saw the leverage and I wasn't as concerned. I guess that. So, like, in that story, in my mind, Latin America was a mess when I got involved. That's where a lot of their profit comes from. You've got declining Bud and Bud Light in the U.S., so people don't like that. But it's somewhat offset by Stella and Michelob Ultra taking some shares. So their dollar sales are relatively flat here, but it's not ideal. But, like, Asia was the growth engine. And now – and not just – I hear you laughing. Not just that. They over-index, so they're sort of like, this is an imperfect example, but they're a little bit like Apple in that they sell fewer units but capture a large majority of the profit over there. And the reason is they over-index in nightclubs. Well, no one's going out right now. Yeah. Like, this is just going to be brutal.
And
they have a ton of leverage. Yeah, well, it's caused me to look in the mirror a little bit and be like, okay, are you going to be a business owner or a stock trader? Because if I own a business and this is going on, I don't sell the business ever in this scenario. Like, I'm reminded of John Malone 2 years ago. Charter was pretty low when he had his annual meeting. And he was just like, all right, fine. People don't like my stock right now. They will later. And it was a little comment that he said, and it really, like, clicked for me. It was very insightful. Like, fine, you don't like my inventory. I don't need to sell it to you. And to me, like, if I owned AB InBev, there's no way I would sell it right now. But the stock, It gets enticing to try to dance in and
We'll
out.
trade the volatility a little bit. Take advantage of the volatility.
Yeah, I don't know that that's the game I want to play. But
Put
I
a
don't
little half
fear.
position on. Little half notional position.
Yeah, I don't know.
Speaking of the loan, though, the EBITDA goat, Discovery's traded down where he dropped the $75 million. So if you like that,
people
then
need to realize, though, that's like no money. That's nothing to him. That's like you and me buying a Prius.
it's not nothing. He still ran through his screen, found out which one had the highest price to free cash flow, and dropped what he had on it.
Yeah, I'm just saying the 75 million. Like I discount.
It's
that
not
a
the
little.
scale of it. It's the fact that he did it.
That's right. Yeah, that's fine.
He knows that business and he buys it at a price. And now you got an opportunity to buy it at a lower price.
Well, CBS Viacom, I just sold this trading below what CBS is trading. Hat tip to my man Matt Ball. Wish I still had your service, but you discontinued it. Thanks for listening. One of the 10.
I got
famous people in our team.
Dude, we have so many. I mean, I think we have 12, 10 listeners, and they're fantastic people. But a lot of those media assets are getting crushed, which, I get it. It's hard to walk in front of the cord-cutting train. But
I
could work out real well.
I got a Buffett quote for you from Jonathan Tepper. It makes no sense to lend money to the government at 1.4% when it is government policy to have 2% inflation. Warren Buffett.
Yeah.
Never heard of him.
Good line.
Who's that guy?
Yeah, I mean he's railed against long-term bonds, U.S. and I think otherwise for a while now, right? He's been a seller of those, but not a buyer, an issuer, I should say.
Short of being sued for breach of fiduciary duty, why would you recommend to anyone to buy bonds?
Well,
not financial advice.
It's
not financial.
The theory is that if we go into a drawdown, then bonds should rally.
Over the short
From
term,
1.3 down to what?
But when they get to that close to that zero bound, they're going to move a lot more. Like the change in the rate it has more impact.
That's what I was talking to my buddy about Microsoft today. And I told him, I was like, honestly, I could see it easily up 40-50% from here. And the reason is what you just said. Like, when your cap rate is so minimal, small changes, I mean, it's trading at, I don't know, like a 3.3% free cash flow yield. Adobe's 2.5-ish or whatever. That's roughly 21% upside right now. I could see people saying Microsoft's worth a lot more than Adobe. Like,
just
the
bond
price,
proxy.
Yeah, the price can just go nuts, right? And I would say, yeah, I get it. I wouldn't bet on it, but I'd get it.
The only thing is that Buffett sort of did that in the 70s, right? When we had stagflation in the 70s, and the Yellow Rock did a lot better than Berkshire did through that period of time.
The elusive Yellow Rock.
I don't know how elusive it is, but yeah, I hesitate to say it because this is basically a value, and I don't want to get hazed by all the people who hate on it. But I don't own any at the moment either.
I don't mind it. I've done real well in it in the past. My grandma gave me some, and then I sold it in I don't know, was it like $1,600 an ounce a couple years ago? It was a good sale. But I've
magic beans.
Yeah, at the time I think I actually bought Caterpillar stock.
I've got a mailbag question if you guys want to do that. It's a very, very long mailbag question, but Yardini Research.
All right, well, I'm going to take a break then.
I can't read this whole thing out, but basically Yardini uses the Fed model to provide a fair valuation of stocks relative to bonds. They use the 10-year Treasury.
Haven't we disproved this model or no?
Yeah, we have, but this
it won't die.
It's a specific question. They argue that based on the historical relationship of the two, the S&P 500 is actually in the region of 70% undervalued, and fair value is in the region of 12,000, which is a 250% gain from here.
Melt up.
I think that the point of the question is, from a purely objective point of view, 4% yield on equity with growth is more attractive than 1.6% no growth on the current 10-year. I mean, what do you guys think about that?
Yes.
Just because something is stupid and insane doesn't mean something that's a little less stupid and insane is a good idea.
I don't know, man. I don't know that I agree with that. I really don't. And this is why. So everything that I own is not sassy, other than my 10 basis points that disqualifies me from discussing value. But I do think that there is room in a portfolio to hedge, because there's no guarantee that bonds don't go negative. And I mean, it's insane for me to say that, but if somebody said, look, I'm going to allocate 10% of my portfolio to like a barbell strategy, and Adobe and Microsoft and all them are going to be that sort of far out barbell, and they're going to outgrow bonds, I don't think that's the craziest thing I've ever heard. I do think you're taking some risk that I'm not comfortable taking, but I do get it. I mean, I don't think it's irrational behavior.
If the 30-year goes negative, what is Microsoft worth?
So much.
Infinity.
Yeah, 4 trillion, 5 trillion. Why not? I mean, the numbers get crazy.
Because there's no price at which Microsoft gets a negative yield, right? Like, that's a function of their underlying business. So if you can yield 0.01%, it's still better than -1.
Yeah, and their services business is growing like a weed, and margins are inflecting, and you can really talk yourself into some crazy stuff.
This time is totally different.
I mean, the scary thing for me that I think about is, like, if this is really where we're going to go, and by this, I mean, like super compressed yields driving price. And, I guess that people would probably argue back to me that people have a floor under what their hurdle rate is. I don't know that I actually believe that. I believe that theoretically there should be, but I don't know that behaviorally there is. Like, what do you do if you're a young person? It's hard. I mean, if you're buying like some of these companies at 2x the value that they're at today, I hope inflation never comes back, because it seems like you're going to end up – it just seems like ripe to just destroy people someday. And I don't know when the day comes.
Well, I lived through this very similar thing when everyone I talked to in 2004 was telling in California to buy a house because otherwise you'll never be able to afford one. And that was the argument, was like, you better get in now because you won't be able to afford one if you don't buy it now. And that was what everyone said. And for 2 more years, that was true, and it got worse. But then reality reasserted itself, and it turned out to be not true.
Only briefly.
Well, for a while. You had a few years there where you could buy a reasonably priced
It's
property,
approaching 3 standard deviations again, which is
it's bad again.
Grantham's
what,
definition
housing out there?
Yeah,
Yeah.
That's Grantham's definition of a bubble. It's approaching his, and he had tracked it for a long time. He hasn't for a while. Actually, all of the websites that used to track it don't track it anymore, which I always find a little bit suspect.
To be fair, you guys have like unending demand and not enough supply and jobs. So there's that. But you also have taxes.
Last year was the first year in a long time where there was
net migration out.
Yeah.
Yeah. My mom's in Scottsdale. She says a lot of people are going from California. But, oh God, I hope it implodes. Not for you guys, but for me. I want to be out there so bad.
I mean, let me ask you this: as far as the argument of this melt up and yields going even lower due to treasuries, I mean, isn't this by definition speculation?
Yes, I think it's hard to argue.
You can't really call it investment at this point, right? You're speculating that someone's going to pay you more because treasuries go lower.
Yeah. Yeah, I do think so. I guess that it doesn't feel like that to me yet. So in the same Microsoft conversation, I was saying, compare that to Delta, which is pretty front loaded with the cash flows. So they guide to $4 billion in free cash flow. I said, I think in a down year, maybe you hit $1 billion, like in a real down year. You're probably going to be closer to 4 more often than 1, but let's call normalized like $2.5 billion to $3 billion. Market cap is 33-ish. So that's like a pretty decent yield today. Microsoft is 3.5. To me, Microsoft is a much higher quality business than Delta, but I don't know that it warrants that spread. My buddy has been long it for a while, so I said I wouldn't sell Microsoft right now, but I can't get myself to buy it over that being the alternative. But you do have to get into some like hair-raising stuff to get any yield right now. So I don't know. It's interesting. I'm not sure that I answered your question. I do agree with you that if you're buying 3%, expecting it to go to 2% on 50% appreciation, that to me is almost certainly. Actually, it's probably more than 50% the way the math works. But yeah, that's almost certainly
speculation.
Yes, that's right.
So I'd say Microsoft's at 3%.
It's like long bonds, right?
Microsoft's a 3% free cash flow yield at the moment, and it's off about 8% from where it was before this kind of little coronavirus came through. I think it was 2.8% when we were discussing it last time.
Was it?
Oh, it's on sale.
I saw a lot of stuff. I'll tell you what, like Pepsi and Coke. Ooh, I mean, that's rich. I know that they're doing good things, but at least with Microsoft, you have something growing like a weed. I mean, Pepsi and Coke, I don't know. I wouldn't lever up to buy them, I'll tell you that.
I've got lots of mailbag questions, but I got them. They're all spread all over everywhere, and I can't track another one down. I've got. Actually, that's not true. I've got. I feel like we've covered a few of these a few times, but here's another one. Should we double down on our stocks after a thoughtful review is done? What's your rationale for your decision? What do some other investors suggest, and what are you going to do in this review? From Chris.
Well, I've heard Michael Mauboussin talk about this as the man overboard moment. So you should be pre-planning on what you're going to do when your stock drops 50% on you.
I like that.
And does that trigger? Obviously, it should probably trigger a reassessment. Like the market is telling you something. Whether you agree with it or not is a different story. But I think you should be looking to see, are the assumptions that I'm making this investment predicated on still true? And if so, then this is an opportunity for you to potentially double down. If not, then maybe you hold or cut your losses and learn something from it. But the time to be coming up with a strategy for the man overboard is while you're calm, while you're thinking rationally, while the markets are calm also, and not after the guy's already fallen overboard and you're like, oh God, now what do I do?
Could not agree more. I mean, three examples that I have, like AB InBev, I don't know that I'm wrong yet, so I'm not going to double down and I'm not going to sell. Wells, I think I might be wrong, so I'm considering swapping out for Schwab. And Delta, I might buy more of. Not financial advice, but those are like three stocks that I still think I'm right on Delta. I mean, I think if you underwrote airlines and didn't think you were going to have a drawdown, then you're out of your mind. So to experience it and live it, this is sort of, they have a strong balance sheet. If you believe in the thesis, now is when you actually want to press your bet a little bit, I think. So I think it's very situational.
Buffett's got you shook on Wells, huh?
Yeah, I don't like it. I don't like a lot of that. I don't like a lot of the stuff in Wells. I think their board is really dysfunctional. I don't know. And yes, I don't think you fade Buffett and Banks.
Toby, from a quant standpoint, do you tend to more double down and even out positions, rebalance?
Yeah, the two best arguments I've seen John Hampton talking about. You got John Hampton talking about Paul Tudor Jones on one hand, losers average losers, and Buffett on the other hand. And I think most value investors would say that they have made a lot of money from buying more of a position as it went down. Like, what are the chances that you pick the bottom of the position that you're trying to buy? Pretty low, right?
Yeah, almost never.
Almost zero. So, but you also have this problem where you've got some risk allocation. You want to be a 3% position or a 5% position or a 10% position, whatever you want. You put 10% of the portfolio at cost, it gets cut in half. Rebuy up to 10%. Now you put 15% of your portfolio into this position. Goes down by half again. You can do that again. Like at some stage, you've got this risk limit, but it's kind of being ignored by the fact that you're stuffing so much of the portfolio into this thing that's going down. And you could be wrong. There's lots of stuff you don't know. There are black swans out there. The way I deal with it is to punt a little bit, because I just rebalance back to even. But then I'm also looking at back to equal weight. Then I'm also looking at, is the business deteriorating? Does that make it fall out of the place where I want to own it? And if that happens, then that decision's sort of somewhat taken away from me. I also think that you have to give positions enough time to work out. What happens often is that a position is bought, deteriorates over the first quarter or so, and then recovers. Like, I think you need to give them at least a year to kind of figure themselves out. So that's a really long, messy way of telling you what I do, which is just to equal weight and then keep on watching them in the screen. And I think that's pretty effective. There are smarter ways of doing it. There are lots of really, really smart, better ways of doing everything. I'm just always trying to find the simple one that I can implement when I'm really, really under the gun and stressed, because it's coming again. There's always one coming.
What's that gambling strategy? Is like Martindale, where you just double down every single time? Yeah.
I think is that a reverse Martingale?
Yeah, something.
I always
like that,
forget.
Huh?
Yeah,
works until it doesn't.
Right.
I mean, I think I just think Guy Spears' book has a lot of wisdom in it, as far as putting up barriers around you. And I probably mentioned it before when we've talked, but the idea that he won't sell a position for 2 years, or like, I don't know if you want to do like a 2.5%, 5%, 10% position going in or something like that. And if it's 10, then you don't double down. If it's 2.5, maybe you do. And whatever it is, I could not agree more with Jake that like having a plan going in and then monitoring whether or not you think you're still right, which the best way to do that is to have a written plan going in. Then I think these decisions get a little bit easier.
It should also turn on the nature of the business that you're looking at. So, commodity, cyclical with a little bit of leverage, that you get one bite at that.
Yep.
Compounder, maybe you can double up a little bit on something like that. That's probably something that you think is going to be materially bigger in 3 to 5 years' time is a much different proposition to something like a cyclical. Like those cyclicals get really ugly at the bottom. Like there's no floor on a cyclical.
Yeah.
And don't assume that you're going to have willpower at that moment, because that's how you end up losing money or getting syphilis.
You love the syphilis line.
I love the Munger joke. It's so funny.
Yeah.
I think that's a good place to leave it, because we're out of time. Thanks, folks. We'll see you next week.
Bye, everybody.
Have a good one.
Move with the rhythm. Shake it up, stop when the clock hits